Are you ready to unlock growth, build resilience, and confidently take the next step in leadership, career, and faith? Welcome to The Next Move. I'm Orvin Kimbrough, a CEO, author, and leader with a passion for helping people and organizations thrive. My journey from foster care to CEO has fueled my mission to help professionals scale their confidence, leadership, and influence through mindset shifts, expanded networks, and bold action. Each week, I'll share reflections ripped straight from my blog to inspire and empower you with actionable insights. Let's get started and make your next move your best move. Welcome back to The Next Move, the podcast where we explore faith, leadership, and personal growth to help you take your next step with purpose and confidence. This is a space where we break down complex ideas about money, leadership, community, and make them real, relevant, and actually make sense. Because too often, financial news and leadership talk feel out of reach. Likely, they weren't meant for the everyday person trying to move forward. I'm Orvin Kimbrough, and if you know anything about my journey, you know I didn't take the traditional route into banking. I call myself an accidental banker because my path was different. I wasn't raised in the system, didn't start in finance, and I never thought like the herd bankers. And that's exactly why we have these conversations, because the way business and money are talked about too often leaves real people out of the loop. But not here. So let's get into it. Today, we're talking about something that confuses a lot of folks, even people in finance: interest rate risks, bond yields, and those flashing numbers you see on CNBC or whatever station you're watching. What do they actually mean for you, for your family, and your business? When I first entered banking, I wanted to understand what other bankers were reading, watching, and how they thought. I remember my days at United Way walking into Stifel's headquarters here in St. Louis, Missouri. They had big TVs everywhere, market data constantly streaming. So when I took my seat at the helm of Midwest Bank Center, I figured I'd follow suit. I turned on CNBC and I was confused. I wake up early, so I'd always catch the implied openings. Those numbers in the corner of the screen flashing red or green, showing where the Dow, the S&P, or the 10-year Treasury yield were expected to start the day. I saw the Dow was up 146 points. The 2-year Treasury yield was flashing green. The 10-year was moving too. But I had to ask myself, how does this impact me, someone on Main Street? How does this impact the bank? And over time, I realized those two things are always connected. Let's make it simple. Bonds, in my mind, is just old debt. So bonds equal old debt. When you hear bonds, it's just old debt somewhere on somebody's balance sheet. A bond is essentially an IOU. It's debt that has already been issued, and investors buy and sell it like a stock. Yield, well, that's the cost of new debt. When we talk about rising or falling yields, we're simply talking about what investors demand for lending money today. Did you catch that? We're talking about what investors demand for lending money today. Here's the key. When bond yields go up, it means new debt is getting more expensive. It's just that simple. Governments, businesses, and consumers all feel it. higher yields, meaning bonds are going up, means higher borrowing costs. Did you catch that? That's why these numbers matter. So why do yields move, meaning the price of new debt? Why does it move? Yields rise when investors demand higher returns for lending their money. Why does this happen? Well, there are several reasons. Strong economic data. If the economy is growing, people expect interest rates to rise. Inflation fears. When inflation is high, investors demand higher yields to protect their money. The Federal Reserve signals. If the Fed hints at rising rates, yields, meaning new money, the price for new money moves up in anticipation. More government debt. When the government issues more bonds, prices can drop and yields can rise. So in other words, the prices of the debt that you have on your books might drop and yields rise. Well, why does this matter to you? Here's where it gets real. These numbers affect your wallet. If the 2-year Treasury yield jumps, credit card interest rates go up. If the 10-year Treasury yield rises, mortgage rates climb. Let's put it in simple numbers. A 1% increase in mortgage rates could add a whopping $200 per month to a $300,000 home loan. That's not just some financial news headline. Folks, that's real money out of your pocket. So let me talk a bit about the bank versus Main Street. There's always a tension between the bank and Main Street. At first glance, banks like higher interest rates because when rates rise, generally, they can charge more for credit cards, loans, and mortgages. But here's the catch. Banks only win if people can still afford to borrow. I remember a conversation with the head of our mortgage division when I first joined Midwest Bank Center. She told me, just watch the 10-year Treasury. If it goes up or down, it will tell you whether it's getting more expensive or less expensive for Main Street. And that's exactly what I did. I just watched the 10-year. But here's where it gets tricky. Most mortgages are fixed rate, meaning banks don't benefit much from rising rates unless they hold adjustable rate products. I remember in one of my mortgages, I had a 5-year ARM, an adjustable rate mortgage. My rate was locked in for 5 years and then adjusted based on the market. If rates spiked before I could refinance, my payment would go up. And that extra money, straight to the lender. And this is where banks and Main Street are tied together. If rates rise too much, people stop buying homes, borrowing slows, and what once looked like a profitable rate environment for banks turns painful. For a bank, interest rate movements aren't just about profitability. They impact the core risk we manage every day. And you've heard me say this before. There are 3 primary risks that every community bank gets up thinking about each day. The first, interest rate risk. The risk that rate changes impact earnings and lending activity. Credit risk. The risk that people won't be able to repay loans, leading to delinquencies. Liquidity risk. The risk that fewer deposits and lower loan demand create funding challenges. When rates rise, lending gets more expensive. And if Main Street can't keep up, it can spill over into liquidity and credit challenges. That's why understanding these numbers matters, not just for banks, but for everyone. So, what's the final lesson in this? At the end of the day, Main Street is the real barometer to all economic activity. If rates go up, borrowing gets more expensive. If rates drop, refinancing opportunities open up. Either way, these numbers shape our economy and our daily lives. So the next time you see CNBC or any station you watch flashing red or green, don't just tune out. Ask yourself, how does this impact my wallet? How does it impact my business? How does it impact my future? I want to hear from you. Have you ever been confused by financial news? How do you think about rising interest rates? How do they affect your finances or your business? And here's my challenge to you. Don't just listen. Pay all of your attention. Next time you see those flashy numbers, take a moment to think about what they really mean for you. If this conversation gave you something to think about, share it with someone who could use it, because knowledge is power. But folks, applied knowledge changes lives. Until next time, take care, and remember, your financial future is yours to shape. Thank you for tuning in to The Next Move. I hope today's reflection inspired you to take the next step in your leadership, career, or faith journey. If this episode resonated with you, share it with someone who might need a little encouragement this week. Don't forget to subscribe so you never miss an episode. And if you'd like more reflections or resources, visit orvinkimbrough.com or theaccidentalbanker.com. Until next time, remember, every step you take brings you closer to thriving. Let's keep moving forward together.